In this second part, let's look at some other techniques in a little bit more detail. Um, as we go through, hopefully we'll be able to describe the techniques, discuss some of their strengths and weaknesses, and ultimately maybe make some decisions about what companies should do when they're choosing investment projects. So we're going to look at two different projects. The first project, you spend $100,000, followed by these cash flows. And the second project is more expensive. You spend $200,000, followed by these cash flows. The discount rate is 15%, and something later on that we'll talk about, the reinvestment rate is also 15%. So what we want to think about as we look at these techniques is, number one, if these projects were standalone, if they were independent projects, would you do both of them if you could do both of them? And then as a second question, if the projects were mutually exclusive, if you had to rank them, which project would you rather do? So let's work our way through. If you look at the actual solutions, here we have what you get from the Capital Budgeting Techniques workshop sheets. Here are the solutions for each of these techniques. We have some benchmarks, right? What are the rules? For payback and discounted payback, we have to set some rules. And of course, we could enter then in the spreadsheet whether you would accept or reject the project based on that investment rule. So again, if we look at these two projects, which would you rather do, right? Let's think about net present value. Which project is best? Project A provides $34,000 and B provides $93,000. I think it's obvious if you could do both of these projects, you would do them both. However, net present value says that by doing project B, you would increase the value of the company more than had you used project A. Now, just as a sidebar, if you decided not to do project B, you wouldn't hurt the company by doing project A. You just would not be maximizing the value of the company. Now, if these two were mutually exclusive, again, project B is the better of the two projects. The payback period, I mentioned a couple of minutes ago, basically is very simple. How long does it take for you to get your money back? If the payback period that you calculate is less than the time that you require to get your money back, you accept the rule. This is used by a lot of companies, especially small companies. The challenge is it ignores the cost of capital and time value of money, so we're really not applying any modern financial analysis to the cash flows. It also ignores cash flows that occur after the payback period. I'll show you that here in a second. And then finally, it relies on this subjective decision, right? How do managers come up with the idea that we need to get our money back in a certain period of time? So if you look at payback period for these two projects, for project A, management said you have to get your money back in 3 years, and it turns out you get your money back in 2. So project A is acceptable. Project B, though, says you got to get your money back in 3 years, but it takes 3.3 years to get your money. So again, project B is unacceptable if the only thing you looked at was payback, because it takes too long to get your money back. That's the issue with this payback period. Now, one of the things we can do, and your book doesn't discuss this in great detail, is we could at least apply the cost of capital, cost of financing, and time value of money and come up with a discounted payback method. It turns out that still both of the project A is still acceptable and project B is even less acceptable. So again, A is the one we want to use if we're using the payback techniques. And again, reverting back to our previous discussion, B is the project that's going to generate the greatest amount of price appreciation. So let's think about the capital budgeting technique called modified internal rate of return. This isn't in your textbook. I wish it was. I think it's a very useful technique because essentially it helps answer the questions, answer some of the issues and challenges that come along with the basic internal rate of return concept. So essentially what we do is we say, look, what happens if you reinvest the cash flows of the company? Think about getting a mutual fund. Every year at the end in December, they send you a check for $500. What should you do with that money? Well, of course, you should reinvest it. But if you think about it, if you're going to get this check in December, right, and it's June, right, you get it in December, what rate of return are you going to be able to reinvest at in December when you're only in June, right? Discount rates, interest rates, inflation, so many things change in the economy that reinvesting cash flows changes. The interest rate that you can earn changes. So this thing allows us to incorporate a reinvestment assumption. What can we reinvest at moving forward? We could make it very complicated and put many different kinds of reinvestment rates in here. This one just assumes reinvestment rates change once. In this case, I assumed the reinvestment rate was 15%. So we want to be able to earn a rate of return through this modified internal rate of return that is greater than the reinvestment rate that we'll be able to invest our future funds at. So let's look at the solutions. For project A, the modified internal rate of return is 22%, and for B, it's 24%. So you see, in this case, doesn't happen in every case, but in this case, it actually fixes some of the challenges that we had with the internal rate of return. Now, project B is the better of the two. Both of them are acceptable if I could do them both. However, B is better than A. The reasons for these conflicts, the reasons for the challenges that we're discussing through here really has to do with cash flows. More than anything else, as we'll describe here in a second, it has to do with this reinvestment rate. How do you actually apply that to future cash flows? Mathematically, if a project size is doubled, its net present value will double. Net present value is based on the absolute values of the dollars. However, the internal rate of return is not affected by the size of the project. Doubling the size of the project will do nothing to the internal rate of return. So when we're looking at two different projects, frequently it's difficult to make comparisons with the internal rate of return because of the size of the projects. Another problem is when the cash flows come. If cash flows come very early in the life of a project, that will have an influence on net present value more than it might have on the internal rate of return. So again, the internal rate of return is a return, but the dollar value of earning a given return depends on exactly how long that return is actually earned, right? The longer the period of time, the less the annualized interest rates that are earned on investments. So an internal rate of return that's attractive for a safe project need not be attractive for a riskier project. We'll talk about this maybe in another context and in other videos, but essentially what we have to recognize is that there are differences in risk. A larger project, just because of the nature of the size, may be more risky than a smaller project. So the cost of capital may ultimately have to be adjusted if we're going to use different risk concepts, right? If the cost of capital changes within the projects, that again can cause the internal rate of return and the net present value to have differences. So one of the ways we can ultimately look at this is say, okay, what about an incremental investment rule? How can we further analyze two mutually exclusive alternatives when we know what the cash flows are? What process can we go through to figure out which of those projects is the best? So here we have two possibilities. You can rebuild an asset or you can buy a new asset. And of course we have our cash flows here. One of the worksheets that we have, cost of capital is 9%. One of the worksheets that we have is the capital budgeting project analysis worksheet. In this case, put in the cash flows, negative $75 followed by 40s, negative 30 followed by 20s. We want to subtract project 2's cash flows from project 1. This gives us what we refer to as our incremental cash flows. So as you can see here, we have this predicament. Net present value is greater for project 1, but the internal rate of return is greater for project 2. So again, there's a conflict. Which one do we choose? By analyzing the incremental cash flows, we end up with basic idea. It says, should we do project 1? If this value is positive, that means that in general, project 1 is going to be greater than project 2. There's a crossover rate. If the cost of capital was 15.89%, both of these projects would have a net present value that was equal. So then at 15.89%, you don't know which project you actually would want to do. You could just pick one. Some of the shortcomings with these incremental rules are, first of all, the internal rate of return might not exist. We might end up with multiple IRRs, right? Again, it doesn't necessarily imply that if you follow this incremental rule that the value of the company will go up. And again, if companies or projects have different costs of capital, it might not be obvious, right? Which cost of capital should you be comparing this internal rate of return to? So again, we have many different choices to make. How do we ultimately make those choices? One final question to ask here is another technique. And this technique should look very similar to the net present value technique. If you look right, net present value minus the investment, this is the present value of cash flows, divide that by the investment. So we ultimately have in the numerator, we have the benefit, and in the denominator, we have the cost. Is the benefit greater than the cost? If the profitability index is greater than 1, then we will be increasing the value of the company. Now, where this is most useful is when the net present values for projects are very close together. So not only do we want to increase value, but we do want to take into consideration being good stewards of our money, using our money to their best resource. There are opportunity costs that we may be able to recover if we can use our money a little bit better, maybe increase the wealth more of the company. So if you look at the profitability index again for A, 1.34, it's greater than 1, so project A is good. Project B, 1.4, again, it's greater than 1. We want to do that project. But again, if you want to pick the best, project B is the best of these projects. Again, this is just very basic technique of how to analyze the value that's generated from doing projects. This is fairly simplistic. We haven't applied any of the real work. The real work is not in the calculation of these formulas. If, as you notice, they're just a cell. It's a formula. The real work is in the generation of the forecasting, predicting what you think is actually going to happen in the future. In a future video, we will review a real case, looking at all the variabilities and all the things that can make your decision much, much more complicated. So we'll talk about that in another video.